Tax-Lien Solutions.
Action.
Hey everyone, this is Ray here with Tax-Lien Solutions and Wholesale Land and Homes. And Mr. AJ is right there behind the camera there.
What's up, everyone?
So today we just want to present you guys with a different way of thinking. So we call this our 3-option strategy. And as a real estate investor, sometimes we get really stuck on just one type of real estate transaction, right? So hopefully this will give you guys an opportunity to see that, you know, there's completely different ways to look at this, all right? So to give you a little bit of the story before I get into the 3-option strategy here, we're working with a client who originally we bought a property from him for the purchase price of $160,000. Now he actually accepted a down payment of $50,000. He gave us 100 days to rehab the property, get it on the market, get it sold, and then once it's sold, out of the proceeds of the property sale, then he would get his remaining $110,000. So we knew that he was a very open-minded individual, and you know, he really wanted to make this a win-win situation, and it worked out favorably in both of our cases. That he actually approached us and he said, "Hey guys, okay, now I've got $160,000 in my pocket. I know the potential behind real estate. I like to invest in real estate. You guys clearly know what you're doing," and you know, he basically is looking for answers on how to get a little bit more involved in real estate. So within that conversation, he also, you know, somehow forgot to mention that he had another property, right? So, you know, he says, "Hey, look, I wanted to find out how things went with this property, being that everything went favorable. I'm definitely excited about introducing this other property that I have, and I want to see how you guys can work with us." Now, it did not make sense as a rehab property because he was still a little bit, you know, he had paid quite a bit more for the property. He bought it way back when things were inflated, so he couldn't really take a lower cash offer, right? So what we're doing today is we're presenting a strategy for him that we're going to be presenting to him sometime this week. But I just wanted to show you guys, you know, when you think outside the box, you know, you're definitely creating 100% win-win situation for both your client and for yourself. All right, so looking at his property, okay, we did some comps. We're not going to get too big into the comps, but we found a property that was listed for $188,800. Okay, now it did have a swimming pool. It had granite. It had updated kitchen cabinets. It had a, I don't know if I mentioned a pool already, but it had really nice outdoor patio. So there were some definite upgrades that, you know, this other house does not have. So after we removed some of the upgrades, you know, we determined that, you know, the ARV of the property, if you did fix it, can still be in the ballpark of $180,000. Okay, so if you zoom in here closely, you'll see that we have an after repair value of $180,000. Now the way that we structure it, so that when we're talking to people on the phone, we can immediately, anything that you do twice, you should always automate. So we have this formula that in Excel that we built, and it automatically allows you to put information in the yellow spots, and then it shoots everything else for you. So as you know, Wholesale Land and Homes, we obviously have to sell properties at wholesale prices. So if we were to have an ARV value and we wanted to wholesale this property to another investor, or even keep it for ourselves as a rehab, any investors out there, they're normally looking for 20 to 25%. Otherwise, they're really not that interested. Okay. Now, with over 130 houses that, you know, we have flipped, I could guarantee you that our numbers are pretty right on. Okay. So there's a rehab of $35,000. You know, realtor fees are 6%. Holding costs are going to be about 1%. That's your utilities, and that's your insurance. You know, homeowners insurance. And then this does not include any private funding. You should add that yourself if you need private funding. But then we also have 2% for closing cost. Okay, and then if we want to wholesale this deal, we want to make a minimum of $5,000. So automatically our cash offer to this client would be $87,800. Okay, now from this next screen, so this is how we came up with that number of $87,800. I wanted to show you how the first option, which is always going to be our cash offer, that's how we come up with our cash offer option. Okay, now if he was to list the property traditionally, because it is it's a 1971 house, has not been updated. It's actually in very great condition. It's just it hasn't been updated. All right, but so if he was to list it with a realtor, okay, they would really be looking at the property in the price park about 165,000. Really, I don't see them pushing 170 again based on the other comp that sold for 188.8 with a lot of upgrades. So if he listed it traditionally with the real estate agent, that's 165,000 that she would list it for. Okay, now based on his information, he bought this property for 130,000. Okay, and then he ended up putting 20% down, so he has a loan on it for 104,000. After we did, all of the math and everything, he still has a mortgage balance of 79,515.09. Okay, so if he lists it with the real estate agent, they're going to charge him 6% commission fees. There's a property that property that we found the comp for 188.8. On the information line, it actually said that they offered 3% closing cost assistance to the seller. So that's going to be something that he's not going to very easily avoid. So we're assuming that he's going to have that number in there as well, right? Now, if he doesn't, great, more money, but the likelihood of it happening, you should consider it. Then, on average, if it takes about 3 months, this property took over 100 days to finally close. So he's got an additional 3 months of mortgage payments to make. That's $1,830, which he also has to keep the utilities on so they could test everything, inspect everything. So that's about another $900 in utilities that he's going to have over the course of 3 months. So I like to say that it's a potential loss because that's not money in his pocket. Okay, he doesn't get to keep that. So in my book, it's called a loss. So summing all these up, it's 17,580. All right, so what happens is by him selling it for 165, owing a balance of 79,515, and then having all these incurred costs, he's going to walk away with $67,904.91. Okay, so obviously that's a much better scenario than if he was to take our cash offer of 87.8. Okay, well, this is where most real estate investors walk away from the deal. Okay, this is where they're like, okay, we're done. Now over here, if we refer it to a realtor, we get a little bit of a kickback. So it's not a major loss. We make a little bit of money there by referral. Now here is, I have it a 3-year term, perfect tenant program is what we call it. Now I really realistically prefer a 5-year, but I did it on a 3-year because it depends. Some people, they need to cash out right away. Okay, but you're definitely going to make the most money on a 5-year. Both of you guys will, you and the client. So now I'm going to briefly explain this here. Okay, now as a perfect tenant program, I'm actually going to offer him more than he would listing it with the realtor. Okay, I'm going to offer him $170,000 for his property. Now he still has the same mortgage balance, but I'm going to ask for a 90-day delay. Okay, now what does that mean? I'm going to ask him to cover at least 90 days of the mortgage payment and the utility bills. It gives me an opportunity to find an individual who's going to move in and rent the property. Okay, so he's already having to account for that traditionally, right? So he should not really object to him paying another 3 months of mortgage and utility bills, because his profit loss is his loss is 2,730 compared to 17,580. Okay, now based on this scenario of a 3-year program, okay, after 3 years, we're going to be making payments, obviously, right? And as we make these payments, it's going to reduce his balance over the course of 3 years. If we make his PI payment, principal and interest payments, it's going to reduce his principal by 9,118. It's money that he did not have to pull out of his pocket. It's money that's coming from us. In essence, we're paying his mortgage. And by doing that, we're reducing his principal. So at the end of the 3 years, when we purchase the property, his balance is now closer to 70,000 instead of 80,000 or 79.5. Okay. Now I'm going to use a 5-year plan because this is really based on his experience. Our conversation with him, he's looking a little bit more long term. So over the course of 5 years, okay, I'm going to go over in here. Over the course of 5 years, okay, his balance is going to get reduced. His principal balance will be reduced by $15,954. Okay, so going back over to here. Now, what that means is that by us offering him $170,000, okay, his balance immediate, balance is $79,515, and then by us reducing his principal, he actually stands to make a profit of $103,708.91 over the course of 5 years instead of traditionally selling it now. Okay, but that's not where it stops. Okay, we're actually sweetening the deal because, like I said, he wants to invest his $160,000. So I'm gonna go here. So just keep this number in mind: 103,708.91. I just rounded it off to 709. So we're gonna purchase the property from him for $170,000. He's got a payoff of $79,515. Now he's gonna give us 90 days, okay, that he's gonna pay for. That's $2,730. So that leaves him with a profit of $87,755. Now, how is this different from the traditional? Well, I don't need a realtor, so he's gonna save 6% because I don't need a realtor. So that's putting money in his pocket, okay. And then, I don't need sellers closing cost assistance, none of that. So that saves him another 3%. So this is why he's actually able to, right off the bat, make $87,000 compared to the other 67. So now when we add the 5-year principal reduction profit, that's the 103,709 that I asked you guys to keep in mind, right? So the 103,709, I just rounded it off right there. See, there it is, 103,709. Okay, but like I said, he just received $160,000 from the proceeds of his last house. Now, if he goes and he pays off his mortgage existing balance of $79,515, okay, right now his payments are PI are $605.60 a month. Okay, so I just took the average of every January for the next 5 years. How much of that $605.60 is he paying in interest alone? So in 19, it's $268.81, all the way down to 2023, it's $240.43 of that, from his principal here is going towards interest. So I took all 5 years, divided it by 5, the average came up to be $254.76, just to give you an idea. So over the course of 60 months, okay, if he pays off using the 160, he goes and he pays off his balance of $79,515, he's going to be saving himself in interest $15,285.72 approximately. That's how much he's saving in interest over the course of the 5 years that, he's going to finance the property to us. So we're going to add that to his already $103,709 5-year profit. And then his interest savings, $15,285. His new profit will now be $118,994.72. Okay. So as we talked about, we plan to purchase the property from him for $170,000. Okay. Now we're only going to have to put $5,000 down. So that means that he's going to carry a note for $165,000. I offered to, pay that with a 2% interest rate. Now some people would be like, I'm not going to make 2%, but you have to look at the big picture here. It's the way that we're structuring this deal. So at 2%, my payment to him will be $609.87. So even if he did not want to pay off his balance, my PITI covers his PITI. So he's still not having to come out anything out of pocket, and his principal is still getting reduced. Okay, but assuming more than likely, based on the conversation, that he will pay off the mortgage, then what happens is he gets to keep all of that $609.87, right? Now, over the course of 5 years, okay, over the course of 5 years, right here, so I'm going to end up paying this property off sometime in, it's going to be about January of 2023. So
over the course of 5 years, when, because we'll have a 5-year balloon payment, after January 2023, I will have paid $15,479.53 in interest, and my balance would still be $144,000 roughly. So $15,479.53 is going to him in interest over the course of 5 years. So when we take his new profit here of his savings and interest, and then what interest he's going to make off of us, his new profit now is $134,474.25. Now that's a whopping difference of taking $134,474.25, which is his new profit, minus what he would traditionally make selling today through a realtor of $67,904.91. He's actually making an additional profit of $66,569.34. I mean, that is doubling his money practically over 5 years. And again, he doesn't need the money, right? He is looking to invest. So over the course of 5 years, he could double his money. Is that not a great investment for him? Is that not a great investment for us who only have to come up with $5,000 down? Now, that's the next question, right? What's in it for us, right? As how is, now we see how he wins. How do we win? Okay, well, I like to call, what are my 3 E's in real estate, my 3 profit E's in real estate. Number 1, instant equity, okay? So this property rents on average for $1,250. Let's go in here. So, based off of just Zillow alone, okay? Now they're saying that the property is worth $184,871, okay? But I never rely on Zillow for comps. It's a great starting point, but of course I do my own comps. But based on just the basic information from them, it rents for about $1,250 a month, okay? And it's projected to increase in value over the next year 5.3%. All right? So instant equity. If my payment is $609 roughly, and it's renting for $1,250, okay, there's instant equity. It's not money coming out of your pocket. You're actually putting money in your pocket, okay? Now there's also future equity, okay? That's the next E. The property is projected to increase in value by 5.3% next year. Now I don't care if it's 3%, if it's not the full 5.3, if it's 3%, but it's projected to increase gradually, okay? So the definite potential of, future equity is 100% there. Now, forced equity. So we, in running the comps, we were able to find that there was comps in the area that support a sell price of $2,025. Okay, so here's one property that's really close by, $2,025, almost the same features to the property, but completely remodeled kitchen, bathrooms, new cabinets. It's all been done. New windows. So there's definitely been some upgrades on this property. Now, what do we call that? We call that forced equity. Okay. Now, forced equity, what that basically means is that you're going to go into this property, you're going to rehab it. Now, we do have a construction company called Ray Model. So, where we've done, well over 130 flips. So we have the team that can come in there and rehab these properties. Okay. So we go in, we rehab it, the property, we can push the price of the property up to $2,025 by putting some rehab expenses into it. But let's say that you rent it for about 4.5 years, right? So you've got some you got some instant equity from the rental, and over the course of 4.5 years, it's gone up in value. Okay, so you bought it for $170, it's now worth $190. It's $200K, right? So you got profit there, and the last 6 months, you go in, you rehab it. And if it's now worth $190 as it stands, by rehabbing it, you should easily push the numbers to $230, $240, right? And keep in mind, you purchased this property for $170, and throughout the course of this time, you haven't really put a lot of money. Now, granted, there's things that break throughout the property. Like I said, this house it's outdated, but it's in very excellent shape, okay? So the roof, the AC, water heater, plumbing, all of the major components that can cost you a lot of money have been inspected. They're all in amazing shape. So,
it's just another way to look at a real estate transaction with a different way of looking. So hopefully being able to see this 3-option strategy makes sense, and hope you learned something from it.
Tax-Lien Solutions.